The central bankers' plans are failing, and if we keep on going down this road, our money could become worthless. Think this is impossible? Well, history is full of currency collapses. Argentina, Hungary, Ukraine, Iceland, Venezuela, Zimbabwe, and Germany have all experienced currency collapses and hyperinflation. And the root cause of all these collapses throughout history has been people losing faith in their currencies to be a store of value and a medium of exchange. Because at the end of the day, these pieces of paper have no real value except that we believe it has value. But as soon as people start losing faith in the currency, that's when the money's in trouble. This can be brought about by improper valuation or pegging, chronic low growth, or high inflation, which we're all experiencing right now. So people, in today's video, I want to go over how the central banks are about to make a big mistake. In this video, I'm going to show you the proof, the facts, and the data that they may not be able to stop inflation. And if they do fail to stop this inflation, and if we experience hyperinflation, your money is going to become worthless. And this scenario would actually be much worse than a stock market, housing market, bond market, cryptocurrency crash. Because once that money loses value, you lose everything. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, so let's go back in time to year 2020. This is the time, as we can see in this chart, the central bank started to print money like crazy. And the M2, the money supply, went here from around 15 trillion all the way up to 21.7 trillion today. What we saw during 2020 and 2021 was the biggest bailouts in history and the most dangerous monetary experiment in history as well. They told us, don't worry, all this money printing, all this stimulus, it won't cause inflation. Quite the opposite happened. We are now experiencing the highest inflation in over 40 years. And what many people don't know, the Federal Reserve didn't just bail out the banks, they bailed out absolutely everyone. They started buying government bonds, mortgage-backed securities, but they also did something unprecedented. They started buying corporate bonds. Any corporation that needed a loan, they got it. People thought, hey, this is great, free money. But you know the saying, there's no such thing as a free lunch, people. We're now starting to pay it back with record inflation. Another chart here, this is the US CPI data. We can see in June, it started to tick up from 0.6%. Then it started to rise, and then we hit a peak inflation rate of 9.1%. But we all know the real numbers are much higher than this. And the central banks and the government officials started this narrative that don't worry, this inflation is only transitory. It's only temporary, then it'll go away. Well, that didn't age well. It wasn't transitory. So what are they saying now? Well, don't worry, inflation has peaked. It's not going to get any worse. This is the worst of it. While we just keep on getting more and more inflation data, and around the world, inflation just keeps getting worse and worse and worse, from the US to Australia to Europe. And you know what the bankers are doing now? They are absolutely panicking, because what they're doing right now is they're playing chicken with the markets. They're like a man, hold me back, I'll get him. When really, when they let them go and they say, okay, go fight inflation, well, the central banks are not doing enough. And the reason why they're panicking is because in November, the Federal Reserve is going to lift the interest rate to 3.75 to 4%. But when we study history, every single time when we've had inflation getting worse and worse, getting entrenched, central bankers have always had to lift interest rates above the inflation rate. And now the markets are starting to price in that the Federal Reserve will have to lift interest rates to 5%, but people, it is not going to be enough. And this is leading to my biggest fear that the central banks will fail to stop this 40-year high inflation. Because look at this, central banks will fail to tame inflation without better fiscal policy, studies say. What have we seen recently? We've seen governments like the UK, they've gone against what central banks is doing. They try to take on more debt, do tax cuts, create more stimulus, and this caused absolute market mayhem. And I don't think that was the end of it. If monetary tightening is not supported by the expectation of appropriate fiscal adjustments, the deterioration of fiscal imbalances leads to even higher inflationary pressures. So that's exactly right, everyone. And that's why during these crashes, governments aren't going to be able to produce huge amounts of stimulus like they could during 2020 and 2021. And if they do, it is going to cause this inflation to turn into hyperinflation and get out of control. As a result, a vicious cycle of rising nominal interest rates, rising inflation, economic stagflation, and increasing debt would arise. In this situation, monetary tightening would actually spur higher inflation and would spark pernicious fiscal stagflation. Well, people, we're already in stagflation. GDP for the last 2 quarters in the US has been negative. All other countries are experiencing very low GDP. And with inflation at 8%, well, guess what? Really, we are in the negative, or even in the US's case, even if they do get some positive GDP for Q3 or Q4, again, in real terms, they're facing negative GDP growth. The Eurozone, which is also struggling with high inflation, is likely to follow a similar path, with its deficit hitting 3.8% this year and staying elevated for years, particularly as the bloc is likely to suffer recession starting in the fourth quarter. Well, again, if people in Europe can't afford to heat their homes, if they can't afford to keep up with grocery bills, if they can't afford to pay rent, they're already in a deep, deep recession. The study argued that around half of the recent surge in US inflation was due to fiscal policy and an erosion in beliefs that the government would run prudent fiscal policies. Well, everyone. So the governments right now, they're trying to blame it on everything else besides themselves. They're trying to blame it on the supply chains. They're trying to blame it on the war. But none of them are admitting it is because they made a huge mistake by overstimulating the economy and not taking out that stimulus fast enough. Right now, there is absolutely no place to hide. From stocks to bonds, gold, silver, cryptocurrency, everything is getting crushed. Just look at last week, 99% of companies lost value. And I'm sure we've all had the same thought. Wait, I'm well diversified, but why is my portfolio still getting hammered? Well, it may be because we're not diversified in the right way. We haven't had this inflation crisis since the 1980s, so we need to hunt down a solution for our time in 2022, learn from history to see how we can hedge from this inflation crisis and from this broad-based market sell-off, because I don't think this is a buy the dip opportunity. I think, and many of you think, it is going to get worse. And Goldman Sachs just released a shocking report last week that says the traditional 60% stocks, 40% bonds portfolio is no longer working. And just look at this chart here. The 60/40 portfolio has seen its worst returns in over 100 years. And we all know day trading is very risky and doesn't work for the majority. Value investing isn't working right now because even value stocks are getting hammered. And Bloomberg has just released his report, Markets roared by inflation leave investors with nowhere to hide. As a result, Goldman Sachs says the ideal stock allocation has shrunk from 60% to 45%. So what do they recommend to do with the difference to salvage your returns? Well, they're saying it's time to invest in real assets. And one of those real assets is contemporary art. Look at this chart here. Real assets have outperformed a 60/40 portfolio in periods of high inflation. But the last time inflation was this high, from 1973 to 81, it appreciated at an average of 17.5% per year. And I've been telling people this for months, and that's why I've partnered with Masterwork. They sold a painting just this month in October for a 21.5% net return to their investors. Can you name an investment that's delivering that kind of value right now? And not just in times like these, but the last 26 years in a row, contemporary art has outpaced the S&P 500 by a huge 131%. As a result, Masterwork has had to acquire more art to keep up with the demand, and there is a wait list. But for my subscribers, you can skip the wait list, click the link in the description, also leave a pinned comment, and you can sign up with Masterworks today. Now, back to the content. Now, did you know the inflation crisis would actually be much worse in the US if it wasn't for the US holding the world reserve currency status? Because it has world reserve currency status, whenever there's fears of a global recession, people flock to the dollar. The dollar's getting stronger, that's making imports cheaper, so that is actually keeping a lid on inflation. But if the dollar starts to crash, we're going to see this inflation crisis in the US get much worse. And also, if the US loses world reserve currency status, which is looking more and more likely, because let's have a look at history to see how long these empires have held world reserve currency status. Well, look at this chart here, everyone. Portugal had world reserve currency status from 1450 to 1530. Then Spain had it from 1530 to 1640. Netherlands had it from 1640 to 1720. France had it from 1720 to 1815. Britain had it from 1815 to 1920. And the US has it now from 1920. And the Great Reset is saying it's going to stop at 2030, and maybe there'll be a new world reserve currency status then. So when you look at the history, the average world reserve currency status has been around 100 years. Now, nobody can predict the future or the exact date, but the best thing you can do is learn from history, and what history is telling us is that the days that the US holds world reserve currency status is numbered. But it's not only this. Right now we're seeing fragmentations in a global economy. We're seeing the BRICS nations become more and more unfriendly with the West. BRICS is the acronym coined to associate the 5 major emerging economies: Brazil, Russia, India, China, and South Africa. And more recently, Saudi Arabia is becoming less and less friendly with the US, and the US has even threatened to stop supplying them with their security tools. And what the BRICS nations are trying to do is to create an alternative to the US dollar. Because look at this chart here. This is a chart of global dominance of the US dollar in global trade. We can see here in 1999, about 70% of global trade was done in US dollars. Well, now it is falling rapidly down to 59%. And look at this red line here, that is 10% other currencies, and that is rising. And there's been even speculation that the BRICS nation could create a commodity-backed currency, whether that be gold or even oil, because both of these commodities are in high demand right now. So this is how the Federal Reserve and the US government could lose its world reserve currency status. If the Federal Reserve creates money and the US government assumes and monetizes debt faster than US economy grows, the future value of the currency could fall in absolute terms. Now, what's absolutely terrifying right now is this is actually happening. Look at this. The squeeze that has the US Treasury thinking about buying back bonds. So this is absolutely crazy, everyone. If they do this during a time of record inflation, people are going to lose faith in the US dollar, in the US government, because they are insolvent. With interest rates rising, with debt at 31 trillion, there's absolutely no way they can afford to pay it back unless they hyperinflate away the debt, which means they're going to sacrifice you, the 99%, to pay for it. The most realistic is a dual threat of high inflation and high debt, a scenario in which rising consumer prices force the Fed to sharply raise interest rates. Much of the national debt is made up of relatively short-term instruments, so a spike in rates would act like an adjustable rate mortgage after the teaser period ends. If the US government struggled to afford its interest payments, foreign creditors could dump the dollar and trigger a collapse. Again, people, this is happening right now. The 2-year Treasury yield is actually higher than the 10-year US Treasury yield. And with the Japanese yen collapsing, with the Chinese yuan collapsing, they're going to have to dump US government bonds to get US dollars to sell those dollars to shore up their own currency. So what this is all going to lead to in 2023, I think inflation is actually going to get worse. The US right now is draining their strategic petroleum reserves. They're going to have to refill them at a much higher price in 2023. And if the US government does start printing more money, we're going to see inflation skyrocket like you've never seen before. And what this will cause is, like what happened in the UK, something in the financial system to break. And this is going to force the Federal Reserve, like how it forced the Bank of England to intervene to come in and buy everything. Again, with the Federal Reserve doing that, along with the US government, that would be the end of the US World Reserve currency status. And it could get so bad that we could experience hyperinflation and our money becoming worthless, like Argentina, Hungary, Ukraine, Iceland, Venezuela, Zimbabwe, etc. So everyone, I hope this scenario doesn't play out. And what I do hope is they'll be able to lift interest rates. Yes, it may crash the markets. Yes, it's going to cause a painful recession or depression, but the cost of high inflation will be much worse. So what I'm doing right now to prepare for that scenario is I'm trying to hedge my bets right now. I've already stocked up on food. I've already stocked up on water, daily essentials. If you haven't done that, do that now, because these are going to absolutely skyrocket during hyperinflation. So what I'm doing with my leftover money is investing in things like gold, silver, and contemporary art as an inflation hedge. And as the stock market, cryptocurrency markets hit my price targets, I'll start dollar cost averaging in them as well, because if we do experience hyperinflation, in dollar terms, these markets will go up, but I don't think they've hit the bottom yet. So everyone, what do you think about this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.